Look at the gold inventory in the COMEX warehouse, and they hit a record high. But could you please take a look at when this happened, and it never got back to those other levels, and now it's even higher because the dangers are even more. So you have to ask the question, who is getting ready for what? Because there is some fat finger or big player here in the U.S. that is demanding physical delivery. And of course, we know, because we've talked about this, that a lot of that physical gold is coming from the Bank of England, among other places, but a huge player in the physical gold market.
Over the past 12 months, gold prices have surged by nearly 40%, finally hitting the $3,000 milestone. While this rally has fueled speculation about a potential gold shortage, the real issue appears to be a liquidity squeeze. The Bank of England, BOE, the world's second-largest gold custodian after China, holds between 8,000 and 9,000 tons of gold underground in London. However, following Donald Trump's re-election in November, political uncertainty and the fear of tariffs have driven banks to shift their gold reserves from London to U.S. hubs like New York. Although gold has not been subjected to tariffs like steel and aluminum, the mere possibility of restrictions has been enough to prompt the movement of approximately 8,000 gold bars, around 2% of the BOE's holdings. This rapid relocation of gold has created significant market distortions, particularly in gold futures trading on the COMEX, the world's largest derivatives market for metals. Since Trump's election, COMEX gold futures have consistently traded at a premium to the spot price, disrupting traditional hedging strategies used by major financial institutions like HSBC and JP Morgan. Instead of taking losses on futures contracts, banks aim to deliver physical gold to meet obligations, further straining gold liquidity. Lynette Zang emphasizes that the sudden surge in transfers overwhelms bank vaults and transport networks, making physical delivery increasingly difficult and heightening concerns about access to real gold rather than just paper contracts. While there may not be a depletion of global gold reserves, the current situation highlights a growing liquidity crisis. As gold prices climb, more institutions scramble to move their holdings, adding to the strain on the system and making physical gold harder to access. Lynette Zang warns that this situation exposes vulnerabilities in the global gold market, where reliance on derivatives and financial instruments creates an illusion of stability. She stresses that the increasing demand for real gold reflects deeper uncertainty in the financial system, reinforcing the importance of holding tangible assets during economic and geopolitical instability. We present the clips of Lynette's latest video. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thanks for your support and enjoy the video.
U.S. gold stockpiles hit record, right? And they're always pointing to the tariffs, but maybe what we're really looking at is a repatriation, because in this country, in the U.S., most of the gold is done in derivative form. That means it's just paper gold. It's not real. And you can look at the gold inventory in the COMEX warehouse, and they hit a record high, but could you please take a look at when this happened, and it never got back to those other levels, and now it's even higher because the dangers are even more. So you have to ask the question, who is getting ready for what? Because there is some fat finger or big player here in the U.S. that is demanding physical delivery. And of course, we know, because we've talked about this, that a lot of that physical gold is coming from the Bank of England, among other places, but a huge player in the physical gold market. They're holding gold for a whole bunch of governments, and they're shipping that gold to the U.S., and then that gold is being delivered out to a private party. So I think that what we've got coming in the future is a massive government global pulling back of the gold. So my question is this really just about the tariffs on gold, Or could this really be so much bigger than that, and it's a repatriation of the physical gold markets? Time's going to tell what it is. We're going to keep paying attention to it. But, I mean, I think it should be pretty darn clear that there are things that are falling apart. And if we're dependent upon the consumer is one big one. What are you going to do when this whole system implodes? Because that's what's happening, and it will. And that's why you have to have physical gold and physical silver in your possession. And you need to have sound money as a foundation for whatever else you're attempting to do. Because a properly diversified portfolio, okay, it can have some intangibles. It can have some cryptocurrencies, some stocks, some bonds, some mutual funds, some ETFs. But you darn well better have the gold to balance that out, so that when the dollar goes to zero, and you might not even believe that it's going to zero. Look at the purchasing power chart. Because the Federal Reserve is telling you that it's going to zero, and it's very close to that now. It's just that little layer of confidence. And if we're having to deal with higher inflation, what do you think that's going to do to the public's confidence in the currency and in those that are driving the economy? That's it. It's the last layer of confidence, and I see it going away.
Fears of an economic slowdown and a resurgence of inflation have intensified as President Donald Trump's aggressive tariffs on major U.S. trading partners are expected to push prices higher and weaken consumer spending. Federal Reserve Chair Jerome Powell acknowledges that inflation is already climbing, partly due to tariffs, and warns that economic uncertainty is rising. Despite these concerns, the Fed still plans for 2 rate cuts in 2025. Though policymakers appear increasingly divided. While the central bank left its key interest rate unchanged between 4.25% and 4.5%, the latest projections show a more hawkish stance, with 4 officials now expecting no rate cuts this year. Lynette Zang emphasizes that the financial system is under immense strain as inflation remains stubborn and debt levels continue to soar. She warns that consumers' growing reliance on credit to maintain their standard of living is a red flag, indicating deeper economic instability. Whether inflation accelerates by June or slightly later, she stresses that higher costs are inevitable and will further squeeze households. In her view, this isn't about political narratives, but economic reality, one where rising debt, inflation, and financial uncertainty push the system closer to breaking point.
The consumer is very, very stretched to the point of breaking. But while tariffs themselves may not spur long-lasting inflation, empirical studies suggest they trigger an immediate, one-time upward shift in price levels that persists. So actually, I think they're contradicting themselves because they're saying that it's not going to spur long-lasting inflation, and yet prices that go up and stay up? Okay, so they just don't want you to realize the truth of it. While higher tariffs create tariff revenue and favor domestic producers for a minute, the price consumers must pay to buy imported goods will increase because firms typically pass some portion of the tariffs cost onto the consumers, or maybe even all of those tariff costs. Because we are a globalized system, the supply chains are all over the world. So even if we are a U.S. company, that means that chances are pretty good that something is going to be imported that's going to be impacted by the tariffs. So there's direct tariffs, and then there's indirect costs that they pass on to the consumers. And that means higher inflation. Now, you guys know I've been talking about the fact that I think we'll see much higher inflation to come about by June. It might happen sooner, it might happen later. I don't know. But either way, of course, there's going to be more inflation. There has to be. The U.S. consumer borrowing surges by $40.8 billion, the most on record. But let me show you what these credit cards loans owned and securitized. So what people are doing in order to maintain their standard of living, they're borrowing more money to do that. there comes a point where they won't be able to do that anymore. Job cuts at those same levels, does this look great to you? Fed wanted to fight inflation. Well, loss of jobs is deflationary, but it is the knock-on effect. It's like a domino. You lose the job over here, but these jobs were also being supported by all these private corporations, and that's getting lost as well. And I'm hoping you're able to see what's really happening, because the February job cuts alone, now understand there was a lot of Doge cuts in here, were 103.2% year over year. That's pretty huge. And the planned cuts last month were the most for a February since, look at that date, 2009. What was happening then? The great financial crisis. So they don't want you to think that that's where we are, but that's where we are. I'm showing you this. How will these job cuts impact consumer spending? Because what happens to all that discretionary income that they might have had when they had a job? That all goes away. Now, I looked at what the the Federal Reserve of Atlanta does their GDP now. GDP is gross domestic product. It's all the money that flows through the system. And while it's not an official forecast, it is viewed as a running estimate of real GDP growth based on available economic data. Let's take a look at this. Oh my goodness. Does that look good to you? Because that is a tremendous drop in gross domestic product, which has an impact on taxes, and therefore it impacts the state services as well as the federal government's income, which then foretells greater deficit spending, both at the state level and the federal level, let alone at the individual level. So even though we're being told that this pain will be short-lived, I don't think so. What do you think? Do you think this is going to be short-lived? Because who's going to absorb all of those people that lost their jobs?
Gold prices have maintained strong upward momentum, breaking past the crucial $3,000 level and reinforcing bullish sentiment in the market. Analysts anticipate further gains, with projections targeting $3,300 in the longer term, driven by tightening supply and sustained demand. The metal's resilience is underpinned by growing investor interest amid economic uncertainty, inflation concerns, and ongoing geopolitical risks. Any short-term pullbacks are expected to be considered strategic buying opportunities, with key support levels at $3,000 and $2,900, as traders capitalize on gold's role as a safe haven asset. Additionally, increasing central bank purchases and growing industrial applications in technology and healthcare further strengthen its outlook. That's it for today. Share your thoughts on Lynette's analysis in the comments section below. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. Thanks for watching and see you in the next one.